Now we will discuss other aspect of merchandise inventory and cost of goods sold. Though, so what is the effect of using different kind of costing method on the inventory cost and on the cost of goods sold and ultimately on the gross profit? So when there is a trend of increasing prices and obviously that it has impact on your inventory cost, and their inventory cost is consistently increasing. So if you use LIFO method, that means last in first out method. So if we are assigning latest cost to the cost of goods sold, so it will increase the cost of goods sold value, which will ultimately decrease the amount of gross profit, because we'll get the amount of gross profit by deducting the cost of goods sold from sales. So if it is higher, so you have lower gross profit. In case of FIFO method, if you are using FIFO method, so FIFO method is the method in which you assign the previous cost, that is first in first out. That means the previous cost would be assigned to the cost of goods sold. So in this case, the cost of goods sold value would be lowest and the gross profit would be high. But when the costs are decreasing, so in this case, FIFO cost of goods sold is highest and LIFO cost of goods sold is lowest. So depending upon these impacts, you can choose the costing method which is more applicable and more appropriate in your kind of business. Other issues related to different kind of costing method and impact of these costing method on different other aspects. So another aspect is that if you are using a LIFO method, which is that you are assigning the latest cost to the cost of goods sold units. So in this case, you have higher cost of goods sold. Higher cost of goods sold give rise to lower income as net income, as the cost of goods sold is higher, which will decrease gross profit, and obviously when there is decreased gross profit, it will also lead to lower net income, and lower net income means that you have to give lower income taxes. So the impact of using LIFO method will give rise to will benefit the company, benefit the organization by increasing its tax burden. And another thing is inventory method and managing income. That what method should we use, what inventory method or what costing method you should use in order to manage your incomes, because obviously every company wants to decrease their expenses, and taxes one of the major expense of the company. So how you can use different kinds of inventory methods and how you can manage income. Then another issue is the international issue, that in many countries LIFO method could not be allowed. So in this case, you have to manage your different activities in order to obviously when if you are working in different countries, you have to follow the rules of that country. So this is another issue regarding using different costing methods. Another aspect is inventory errors, recording in inventory errors. So each inventory, obviously whenever you have any error in recording the amount of inventory or any other error is there, so it ultimately affect four different items. First one is inventory. Obviously if you are making errors in inventory, so obviously it would be overstated or understated. Then cost of goods sold, because cost of goods sold is the value of inventory of those items which are being sold. So obviously it ultimately make impact on the cost of goods sold and on the gross profit and also of the net income. If you see all these items, all these items are dependent on each other. Therefore if you have any error in the amount of inventory, it ultimately impact the other items in this list. If we look at into this diagram or table, you can see that we have two periods, and into two periods we have value of cost of goods sold and gross profit and net income. And on the other side, we can see that there are inventory errors. There are two kinds of inventory error. If in period one inventory is overstated, so the amount of cost of goods sold would be understated, which will overstate the value of gross profit and net income. And in the second period, then cost of goods sold would be overstated, and then which result in the understatement of the value of gross profit and net income. The case would be opposite if the in the first period ending inventory value would be understated. So if the ending inventory value is understated, it will overstate the value of cost of goods sold and understate the value of gross profit and net income. And same is the case with the second period. So this is the impact of recording the wrong value of inventory, because we can get the amount of cost of goods sold from the inventory, because cost of goods sold is the value which shows that what was the cost of those units which are being sold, and the amount of gross profit is can be attained from deducting the value of cost of goods sold from sales, and net income is actually being derived after deducting different operating expenses, taxes, and the interest expense from gross profit. So so if the value of inventory is overstated or understated, it definitely impact the value of cost of goods sold, gross profit, and net income. So we should be very careful while we are recording the value of inventory. Accounting principles, as this the name suggests, that there are certain accounting principles which govern the recording of inventory into accounting records. So these principles are from gap, which is derived from gap. So first principle is a consistency principle. Consistency principle, as the name suggests, that it is suggesting some consistency in using certain kind of method. As we have discussed different inventory costing method like LIFO, FIFO, average cost method, specific cost method. So this principle suggests that when you are using these methods, so use that a single method from period to period. So in different periods, this you should not change the method from different period, because it have different impacts. So you have to use a single method from period to period. But in any case, if you want to change a method at any point in time, so you have to disclose it, and the impact of that change should be disclosed as well. So this is the consistency principle. Then second one is disclosure principle. Disclosure principles is that you have to disclose all the relevant information. These, if these are related to inventory, or in any case if they have any impact on the shareholders value, because in accounting majority of time we are discussing about corporate business structure, and in corporate business structure your major owners or the main owners are your stakeholders, your shareholders. So you have to disclose all the relative information to your stakeholders and shareholders, and make those decisions. These should be relevant, reliable, and comparable information, and these should be disclosed to your stakeholders. Third thing is accounting conservatism. Conservatism means that we should be very careful while recording different assets and recording different profit and losses. So this principle suggests that if you have anticipation of any loss, so you have to disclose it. But if any gains are expected, so you could not disclose it, or you could not report it until they are incurred. On the other hand, we should record asset at the lowest reasonable price, lowest reasonable amount. But in case of liability, they should be recorded at reasonably high level of amount. So in this case, you will be very careful, and you should be very conservative in recording the information of the company. The other aspect of recording inventory into records is lower cost or market. That this is an LCM principle. That means that in the market you have different prices of your inventory, and with the passage of time, these certain times the values are increasing and certain times they are decreasing. So whenever there is a case, so inventory is reported at the lowest value. You have to record the inventory at its lower level, lowest value, historical cost means that at which price you have purchased it, or at market replacement cost. That means that if you want to resell this thing, so at what price you can resell it. So inventory, if you want to decrease the value of the inventory, because at currently the market they have lowest market value, so you have to decrease the cost of inventory. So in this case, you have to make entry into the journal because you are going to decrease the value of your inventory. So record increase in the cost of goods sold, and record the reduction in inventory, as cost of goods sold is like an expense. So whenever there is increase in the expense, it is always recorded as debit, and an inventory is an asset. So if you are going to decrease the value of inventory, so in that case you will record the reduction in inventory and credit it. So to record a 1000 decline in inventory, so you'll make this entry: cost of goods sold 1000, that is debit, and inventory 1000, and you'll write wrote inventory down to a market value. In order to check the efficiency or usage of your inventory, certain ratios can be used. The first year ratio which can be used is called as gross profit percentage, and it can be attained by dividing the amount of gross profit divided by net sales and sales revenue. It suggests that how much percentage is gross profit in the total value of net sales revenue. So the more you have the value of gross profit, the more the company is generating profit. So it is actually a one type of profitability ratio, and if the company want to see their operating efficiency, or if we want to see their profitability, so this ratio is quite helpful. Secondly is inventory turnover ratio. When we talk about inventory turnover ratio, it is actually shows the how much time your inventory is converted into cost of goods sold. So what we'll do is cost of goods sold divided by average inventory. So it will tell us that in 1 year or in one approximately time, whatever you have taken the value is that you have converted your inventory into cost of goods sold, and more you have converted it to cost of goods sold, the more efficient and more there is more an efficient conversion, cash conversion cycle. So these ratios can be used in order to check the efficiency of the company. The gross profit actually is a profitability ratio, and inventory turnover ratio is the operating ratio, or you can say it tells us the efficient usage of your inventory. If you have more amount of inventory and you cannot convert into cost of goods sold, so that shows that company is not properly converting its resources into cost of goods sold. So these ratio is quite helpful while you are evaluating the performance or the usage of your inventory. So obviously gross profit is the profit indicator, and your inventory turnover is the liquidity ratio. That means that how quickly you are converting your inventory into cost of goods sold. It is actually a cash conversion cycle, as your inventory is converted into cost of goods sold, and that cost of goods sold is converted into account receivable or note receivable or cash, and obviously that cash is again converted into inventory, and so on the cycle goes on and on. And if this cycle is completely more quickly, so that means the company is very good, and they are they are very liquid, and they are using its resources very carefully and very efficiently. So these ratios are quite helpful in determining the liquidity of the firm and the profitability of a firm. This slide is about gross profit method. This method is actually used to determine the value of inventory by if you have the value of gross profit. So gross profit method is a way of estimating inventory based on the cost of goods sold model. You can also call it as gross margin method. So as we know that sales minus cost of goods sold give us gross profit, and gross profit percentage is gross profit divided by sales, and cost of goods sold is equal to sales multiplied by 1 minus gross profit percentage. So this is the equation, and with the help of this equation we can determine the value of inventory. In this slide, we can see the example and calculation of gross profit method or GP percentage method. Now, for example, the beginning value of the inventory is 14,000, and the value of purchases is 66,000. And we know that sale is 1 lakh, and the percentage of gross profit is 43%. We don't know the cost of goods sold, and we don't know the ending value. In the solving with the help of gross profit method, we know the value of beginning inventory is $14,000. The value of purchases is 66,000. This will give us the cost of good available for sale. But we don't know the amount of cost of goods sold, but we know the value of net sales revenue. So net sale revenue is 1 lakh, and we also know that gross profit is 43% of the total sale. So we can get the 43%, and the 43% of 1 lakh is 43,000. So this is the amount of gross profit. So estimated cost of goods sold is 57,000. So by dividing 57,000 from the 80,000, we can get the value of ending inventory.